So, welcome to today's webinar. This is a first in what will be a 2 or 3 part series. We've ambitiously said 3. It's going to depend on feedback. So do let us know at the end of today's presentation if this is too much detail or you'd prefer a streamlined overview. I've gone for the detailed approach because simply there is a lot to know. And you're well served by knowing it, and we really shouldn't skip over it. Also, people's situations vary enormously. As you'll see in just a moment, I have my disclaimer here. This is not personal advice. You do well to speak from someone from the Social Security Administration or a financial advisor, or indeed me, if I am your financial advisor, about how this may apply to you. So I'm Ashley Murphy, founder and principal of Arete Wealth Strategists. And we're going to get into this presentation just now. So, of course, it's not personal advice, and also we've obtained this information from what we believe to be very reliable sources. A little bit about me: I'm a tri-citizen, born in the UK, raised in Australia, lived in the United States for 16 years, presently in Brisbane, and I expect to be here for 18 months before returning to Minneapolis, where my firm is headquartered. So there's a little bit about me. I'm also the founder of the Global Financial Planning Institute, where I train other advisors on what they need to know in working with other financial advisors. So I would encourage you, please spread the word. In about a week's time, we're going to have up and live a Find a Financial Advisor function. If you know of other expats who need to locate a financial advisor who knows about what international issues are relevant in your situation. So we work with 3 different types of clients: Australian business owners in the US, Aussie high net worth families in the US, and Australian executives permanently relocated to the US, and of course Americans in Australia. That would be a 4th example here as well. Let's get to the heart of a presentation here today. So we're covering off on these 13 topics to do with Social Security. I figure we already have some basic understanding of what it is, but I'm really hoping to enlighten you, to add some knowledge to what you already know about Social Security, and really set the stage for the next presentation, where we get into more sophisticated concepts such as the totalization agreement and claiming from abroad. But firstly, what is Social Security? Okay, Social Security, also known as, you might have seen it on your pay stub for those that have worked in the US, OASDI. It's the Old Age Survivors and Disability Insurance Program run by the Social Security Administration, part of the Department of Labor. It came about in the Depression, and I believe it was 1933. It came into effect, and it has been really the safety net of the US retirement system since that time, and prevented a great deal of poverty for senior citizens. Essentially, it's an income stream that's paid to you. I don't like to use that word pension because our European friends use the word pension somewhat ambiguously. They mean pension to refer to a defined contribution retirement account, but also a defined benefit, an income stream, as I prefer to call it. So Social Security is a non-means tested, it's a non-income tested above one's full retirement age income stream that is paid to you for as long as you live, and often there's a spousal benefit that goes along with that as well, which we'll talk about in a little more detail. So you see here from the most recently issued Social Security trustees report from last year that they're paying out over $1 trillion to 69 million individuals in the US. Okay, so let's talk very briefly. The disability insurance, there's a very strict definition of what it entails to be disabled. I'm not going to get into that. That's not why you came here today. And the survivor benefit, that is really for a Viking kind of funeral. Last I checked, it was $255, so that would pay for that canoe being pushed out to sea and the arrows on fire being sent onto that canoe. So not a very generous death benefit at all. But Social Security itself is a very valuable income stream in retirement. There's 700,000 beneficiaries receiving Social Security outside of the United States. There's the top 10, with Australia rounding out at the bottom. Now, this comes directly from the Social Security Administration, so we feel pretty good about that. And as you may have heard me say in the past, Australia is the only country in the world, according to the Sydney Morning Herald, so make of that what you will, but that's where I came across this fact, that has more Americans moving to it permanently, that is, than the other way around. So that take that for what it's worth. Okay, Social Security. This is, again, just what is Social Security. So it's very, very, very summarized view here. You need 10 years of work in order to qualify. They'll take your 35 highest earning years and apply a formula to that, and you will receive a benefit as early as age 62. You'll have a full retirement age that is defined by the year of your birth. But from most folks I'm talking to that were born after the 1960, that age would be age 67, as we'll see a little later. So 67 is your full retirement age, and you'll get the highest benefit you get a delayed retirement credit, 8% per year up until age 70. There is absolutely no benefit beyond waiting beyond age 70. It caps out at age 70. Various adjustments will be made to your full retirement age benefit to determine what you actually get paid. And we'll have a couple calculators coming up here in just a minute. So the first one, of course, as you've already heard me allude to, would be when you apply for it. Again, we just said a minute ago, that's any time between age 62 and 70. Widowers can claim as early as age 60. That's an exception there, but typically we're talking age 62 to age 70. So that's going to determine how much you get is when you claim, whether other family members are receiving benefits due to the family maximum benefit limits. That very quickly goes down a rabbit hole. Doesn't affect in the much more common instance of spousal benefits, but if you've got children on disability, for instance, that's where the maximum benefit limits come into it, to avoid what Ronald Reagan once described as pension heirs. And then the other third thing here is if the individual is receiving any pensions through employment that is not uncovered by Social Security or a foreign job, then either one of these two reductions may apply, the Windfall Elimination Provision or the government pension offset. Typically, I have seen that when someone has worked for, say, the railroad department or in a state job. In one of my earlier jobs as a financial advisor was with a company that ran the judges program. Would you believe there's actually a separate pension program in the state of California just for judges? And that particular job does not pay into Social Security, so they end up getting, or they can get a Social Security benefit and a judge's benefit. And then that's when the Windfall Elimination Provision would come into it, so that they're not receiving too much from these two government pensions. Okay. An important fact to cover as we get into this, the status of the Social Security Trust Fund. There's lots of scuttlebutt, lots of rumor and innuendo about the status of the Social Security Trust Fund. Let's talk in facts, because that's what we deal in here. So they release their report every year. The most recent report, they said, as of this year, they're going to have expenses exceed their income. Does that mean their income has gone to nothing? No, it does not. It means that by 2035, they will have depleted the trust fund. That's the current expectation. That may be sooner, given COVID, and that they weren't really factoring that too much, although that was on the horizon, of course, April 22nd last year, but the full impact was yet to be known. But we're looking at a reduction in benefits. And so when we do plans for our clients, we tend to say, yeah, the estimate today is this, but we're going to scale that back and say, you're going to get more like 3/4 of that benefit, because even with that trust fund depleted, there are incoming tax revenues to pay, approximately 79% of that benefit that is expected. And so you see here an article from Forbes referencing the Center for Retirement Research at Boston College, saying that if things if they went as worse as they are likely to go with COVID, then you might see that trust fund deplete a year or two earlier. I don't think we've experienced that, although it is very hard to tell, because the unemployment rate does not include those that are not considered to be looking for work, and many people over the past year have become what's called discouraged workers, and they're simply taken out of the calculation altogether. So it's hard to see exactly what impact that would have on total payroll receipts. But anyway, I thought I'd include that and add that point there that given the status of the Social Security Trust Fund, we use about 3/4 of the estimated amount for long-term financial planning purposes. Okay, Social Security for returned Aussies or Americans abroad. Here's what we need to know here. The tax code considers all American citizens and green card holders to be residents. This is like every single presentation I give begins with this fact. The US is one of, if not the only developed economy in the world. There is Eritrea, which doesn't count amongst developed countries, but China has recently begun to impose this as well. The US has what's called citizenship-based taxation. So what does that mean? It doesn't matter where you are in the universe, provided you are a US citizen, you are assessable for US income, and you must report on certain facts of your financial situation. Does that mean you're going to be double taxed? Probably not, but it does depend on the type of income that you have and the country that you're in, and whether the US has a tax treaty with that country. So we'll never begin a presentation without mentioning that. So the Social Security is unlike the Australian aged pension. I get lots of inquiries about, am I going to qualify for the Australian aged pension? Here's the bottom line. My short answer to that, and I say this respectfully, I don't mean to in any way be disrespectful, but the Australian age pension is not something you want to have to qualify for, because it is both income and asset tested, and you've got to be at lower levels, let's say, to qualify for it in the first place. So for practically zero of my clients do we even talk about it, because it doesn't come up. And I'm not saying I only work with high net worth clients. I'm just saying the limits are fairly low, and it's quite difficult to qualify. And also another question that's inevitable, can I get my Australian age pension overseas? No, you cannot. There's a residency test as well. So they're very strict about it. And I would say rightly so, given how the superannuation guarantee structure is in effect, 9.5% and increasing soon, if things stay on pace, then 12% by 2025. So really, superannuation is considered the primary Australian retirement plan, with the age pension really being the safety net. Okay, so Security, on the other hand, is not means tested nor income tested. So that's to say that Warren Buffett every month is getting his Social Security check. He paid in, and that's his earned entitlement, as they describe it. Another interesting fact, again, this is the sort of nonsense that does the rounds in the Facebook forums, is your US legal residency doesn't matter if you've earned your benefit. So if you were in the US, you're on an L1, an E3, or some visa like that, you never took steps to gain permanent residency or became a citizen, it doesn't matter. If you vested, then you get a benefit. Working outside the US can impact your Social Security benefit in one of two ways, or not at all. And that would be the number of years you paid into the Social Security system, or the right to receive a foreign pension of some sort. Again, the Australian situation, don't see that too often. Of course, it could happen, and whether the government pension offset comes into effect remains to be seen. The first point here is more, if you worked fewer than, let's say, 1.5 years, 18 months in the US, and then you began your globe-trotting career, what's going to happen there? And that really speaks to the next presentation, to do with what's called the totalization agreement, which is where the US has entered into agreements with, I believe it's 40 countries, 41 most recently, where they totalize Social Security taxes with these different countries, to deal with the hypothetical example of the globe-trotting executive who pays into all of these systems and then doesn't vest or get anything from anywhere. The totalization agreement is intended to deal with that kind of situation. Or it could have no effect at all. I would say most commonly it has no effect at all, given two facts. One of which is most clients I'm dealing with have typically been in the US long enough to vest, in which case if they've vested, fantastic. And they've got they have either make too much money or they have too much in assets. They wouldn't qualify for an Australian pension. Therefore, the government pension offset doesn't come into it. No effect. So thus they're vested and they get the benefit, and they don't qualify for the Australian pension anyway. Or the second one here, the right to receive a foreign social security pension, which may lead to a reduction. I think that could happen at a government level. I haven't seen too much of that myself, but it might be possible to receive some kind of federal government pension that could interact with your social security benefit. Or a UN pension. I have seen that before. Okay, what is the Social Security tax? How does it work in the US? Very simple. There's a tax that appears on your pay stub. If anyone's ever wondered what's this mysterious OASDI, Old Age Survivors and Disability Insurance, that's your Social Security tax right there. It's paid on two sides of the payroll. So that is, the employee pays it and the employer pays it, which means if you happen to wear both hats and you're self-employed or own your own business, congratulations. You are both the employer and the employee. You get to pay 6.2% on both sides. So that is how it gets paid. It's only paid up to a wage base. Now, I'll have a further comment here, but up to $142,800 in 2021 is that wage base limit. So you're paying as an employee, as a W-2 employee, you're paying 6.2% up to $142,000. And then at that moment in the year when your income exceeds that level, you'll see that OASDI be zero because you've already fully paid your $8,853.60 into Social Security that year. Now, what I think is interesting and unfair, of course, life is not fair, but whatever, is the adjustments, the inflation adjustments that are made to the actual Social Security benefit that are paid are very different to the inflation adjustments that are made to the wage limit. So look at this. We go from $137,700 in 2020 to $142,800. That's about a 3% rise. And you compare that to a 1.8% increase in the actual benefits that are paid to Social Security beneficiaries. I think that's interesting. It is an easy and stealthy way that the government passes on a tax increase that no one knows about, because the percentage stays the same. It's the wage limit that changes. How do I begin vesting in Social Security? Well, that's a fine question. I already briefly covered that at the outset about the 10 years of of earned income and OASDI tax paid. So the answer is more nuanced than that. It's really 40 quarters of coverage. So you don't have to work a 10-year straight period. It could be at any time in your life, provided you had that full 10 years, the full 40 quarters of paid employment, then you would be fully vested and receive your benefit at your full retirement age. How much would you actually get? Well, we'll talk about that in a little while. But to qualify, the minimum amount you must have earned in that quarter is $1,410, which would mean that you'd have to make $56.40 over the course of a year for 10 years as a minimum to qualify. I had a very interesting conversation with a prospective client recently where they had just moved from Australia, where they had been living for many decades, back to the US, and they had taken a minimum wage job. This is a couple in their early 60s, and they decided to do that because that would mean they would be fully vested in Social Security. Through the total, you'll hear me talk about this next time, but through the totalization agreement, they would still get some benefit. They just wouldn't get their full benefit. So this is a very unusual situation where you had a professional, someone university educated, been making a healthy income their entire career, but because of their move back to the US, they know how Social Security works, and they could see, hey, if I just work a couple of years at this job, then I'm going to get a full Social Security benefit. And so that was advantageous to them to do that. Okay. And you can earn as few as 6 quarters of coverage and still obtain some benefit, provided you were to work in one of those countries. Australia is one, New Zealand is not, that has a totalization agreement with the US. Okay, I'm going to hold off on those questions to the end just because I'm on a roll here. So, a full retirement age, what is the FRA? That is the age at which you earn your full Social Security benefit. I mentioned earlier, for everyone born after 1960, that age would be age 67. It is important. I do find this interesting. It's just an aside here. When Otto von Bismarck introduced the concept of the pension back in the First Republic of Germany back in the 19th century, it's important to realize that the pension began at age 60 when life expectancy was 57. So that would be equivalent these days to making it Social Security start at age 90 or something like that. Obviously, we live in a very different world and things have changed a lot. So there's your full retirement age. For most folks born after 1960, it's going to be age 67. As you heard me say, you can begin taking it as early as age 62, which would result in a reduction to your benefit, or as late as age 70, which would result in an increase. Very, very, very hard to get a superior investment, guaranteed, I should mention, superior investment return to what we have with Social Security, waiting between your full retirement age and age 70. For those whose full retirement age is age 67, that's an 8% guaranteed return if you simply wait to age 70. Here's the table I've been alluding to. So if you were born before 1953, it's 66, and then it's slowly scaled up to 67. Do we expect it to increase? Absolutely, we do. So for those like myself, born in the 1980s, you might be looking a long way off and saying, gosh, the trust fund isn't going to pay 100% of what it says. And also people are living longer. Those two facts combined suggest that we should use a lower amount and we should consider taking that amount from a higher age, and not be surprised in 5 or 10 years' time when that bubbles up to the political agenda. Okay, more on full retirement age. Your benefit is reduced. You heard me talk about that. There's a formula for it. It gets really boring, and we like to use, as you'll see in another slide, we like to just use tools to cut straight to the chase. And the best tool of all, of course, is straight from the Social Security Administration itself. However, let's go back here and look at this example. Mary has a full retirement age of 66, which means she was born in 1943 to, what was it, 1953, I think. So she begins to take benefits at age 62. How would that calculation work? There's the details of it. Essentially, it results in a permanent reduction of 25% of her benefit. It is possible if upon hearing this for the first time and you've commenced taking your Social Security benefit, if you have the means to do so, it's possible to pay it back as if it's like an oopsie. You say, oops, I didn't know that. I didn't know they're going to reduce my benefit by 25 or 30%. I want to pay it all back. And I'm going to continue accruing up to my full retirement age or to age 70 and then commence taking it. So that is a possibility, but there is a time limit on that as to when you can actually pay it back. Okay, what do we have here? Maximum reduction is 30% reduction in benefit if your full retirement age happens to be age 67, thus you're born in 1960. The most you'd see it reduced there is by 30%. And what I'm going to say here is, for me, when I've worked with private clients, when they have the means to do so, it's very simple. It's just a knee-jerk recommendation. If you have there's a couple things that come in, but if you have let's assume someone's in good health, they expect to live beyond age 78. If you're in good health, expect to live beyond age 78 and have the means, and now not everyone will tick every one of those boxes I just mentioned, but if you do, then it makes sense to defer and take your Social Security at age 70, given the change in benefit or the increase in benefit that we'll see in a moment. Not everyone is in that situation, and so there are certainly circumstances where it makes sense to take it at an earlier age. The crossover point, just for those that are wondering, that are mathematically inclined, happens to be, as I just alluded to, it's about age 78. So If you were to say hypothetically, gosh, I could take my benefit at age 62 or age 70, there's 8 years I would have been receiving my benefit had I taken it at age 62. Why on earth would I take it at age 70 when there's all these uncertainties in the world? Well, here's why. Because if you live to be beyond age 78, then you would have been better off waiting until age 70. And with the actually, I'm just about to step my foot in it, so I'll try and avoid that. With the average life expectancy in the United States being in the early 80s, obviously women live 2 years longer than men, but being in the early 80s, that would suggest that most people are going to be okay with waiting to age 70, only slightly, and then risk tolerance and other factors come into it. But amongst those that would consider being taking an annuity, let's say, the average age tends to be a little bit older than that. The life expectancy is older, and the reason for that is because amongst the Social Security population, you're talking about basically everyone in the US, and there's great income inequality and access to healthcare and so forth. And so if you're not in the bottom quartile, then the life expectancy actually goes up by a couple of years. So that, I mention that not to be political, but just these are the facts. We're talking about financial planning, and if your life expectancy is likely to be into the mid 80s, then that could change that decision for you. Okay, how is your benefit calculated? Lots and lots of boring material here that you can go and look at. We don't ever get into that. We just go straight to the calculator and see what they have. So if you click on this link right here, My Social Security, or just search My Social Security, you will be shocked to see how incredibly easy it is to run a benefit. Actually, there's two things. It's been 10 years now. Someone, of course, in the past year, someone said, well, I received something in the mail just recently, which is, I can't argue with that. But it's been 10 years since Social Security Administration stopped mailing statements. These days, you have to go to My Social Security. Let's just click on it for fun. I'm not going to enter my details, of course, but you'll see here that you create an account. I've already created an account. You just enter a username. This takes 5 minutes. If your information matches what they have on file, which hopefully it does, otherwise they're going to mail you something to an address, then you'll be able to see your earnings record that the Social Security has. You want to check that. It's a little bit like one of those low priority things that financial planners always talk about, right? Like you look at your credit report every year to make sure there hasn't been any identity fraud taken out against you, and look at your Social Security earnings record, because if there's an error in your earnings record, that could affect how much you're going to get paid by Social Security. So you'd come here and create an account. Okay. The other tool you can use is this retirement estimator, and that's what we have on the next page. My animation's got a little bit ahead of me here. So you'd come here to this URL, enter again a few more details, and I just used as an example, I said, well, gosh, if you're making $120,000, what might you expect? Let's just talk about some round numbers here. So if you waited till your full retirement age, assuming that's age 67, you would get about $3,000 a month. That's very nice. Hey, no one's going to complain about that. And that's not nothing. I mean, that really, really helps to pay the bills in old age. If it's your only income, then that things could be a little tight. You could take it as early as age 62. Again, we're talking about the reduction in benefits. You see it's more like $2,000 right there. Or at age 70, there you go, you get that kicker, and it's paying closer to $3,800 a month as long as you live. Now, what we're looking at right here is only the worker benefit. There are spousal benefits as well, spousal benefits, which we're going to get into in just a moment. Okay. I'm sure one of the questions that's already waiting for me here would be, well, that's all well and good, Ashley. What if I want to take my Social Security at age 62, continue working all the while until my full retirement age? Well, here's what happens when you do that. You get hosed with tax and your benefit is reduced. So if you have earned income during that period, and you don't have to have a whole lot, it's a little bit over $18,000 for the year, and then your Social Security benefit gets reduced, and it gets taxed as well, or more of it gets taxed, more accurately. But you get a kicker up when you hit your full retirement age. So at your full retirement age, as we said, anyone born after 1960, that would be age 67. So after age 67, you begin to get your full retirement benefit again. So they do reduce it if you have earned income between age 62 and your full retirement age. The general earnings test, what do we have here? So if you begin taking Social Security after age 62, I should have said 19,000. If you have more than $19,000, your benefit is going to be reduced by 50% for every dollar above that amount. That's not very nice at all. And in the year that you reach your full retirement age, so age 67, there's different rules that apply. They increase the limit, and then above that year, it doesn't matter at all. You can earn as much as you like, and your benefit won't be reduced, but it will be taxed. More of it will be taxed, more accurately. What about same-sex married couples? Well, as a result of the Supreme Court decision 2013 with DOMA, it essentially means that same-sex couples are rightly entitled to a benefit as well. So that's some good news there. What about spousal benefits? So a couple slides here on this before we get into Q&A and round out today's session. So spousal benefits. Essentially, you have two types of benefits. There is the worker benefit from your own Social Security and worker history, and there's your spousal benefit. Of course, it makes sense to take the benefit that's higher, and you're perfectly entitled to do that. So if you have a spouse that has never worked outside the home, they are eligible for 50% of the primary worker benefit of their spouse. So that's what we're saying here. The benefit is based on the earnings history of the working spouse and will be paid when the worker applies for and collects their own benefit. Let me see here. A working spouse can collect a spousal benefit. This is interesting. So this is, I wouldn't call it an advanced strategy because anyone getting to this age is going to know about this. But a working spouse can take from their spousal benefit while still working and not affect their own worker benefit. So let's say you have, just a hypothetical here, you and your partner are age 62, one partner, both with Social Security earnings histories, and one partner retires, the other partner continues to work. The one that continues to work can take the spousal benefit up until they retire and then take their own worker benefit, which presumably would be worth more than their spousal benefit. Otherwise, they would stay on their spousal benefit. This is why we've turned this presentation into a multi-part presentation, because there's so much to get your head around. As we just learnt a moment ago, all that glitters isn't gold, because remember, there's a very low cutoff by which point your benefit is reduced. So if you're making over $19,000 taking your spousal benefit, you're still getting your benefit reduced. So it's not that significant a sum of money, but it could be to some. It's highly subjective. The other thing is spousal benefits don't accrue that additional bonus above the retirement age. So if you were to wait until age 70, the spousal benefit is not going to get that 8% kicker between the full retirement age and age 70. Okay, here is a handy dandy chart that my friend Michael Kitsis has put together, where if we were to simply summarize what he's got here, if you have a working spouse under their full retirement age, then their benefit is going to be impacted. So that's essentially the takeaway here. Wage earner must file and collect his or own benefit, as we were just saying. The earliest is age 62. Because this is the benefit that the non-wage earner will receive for the remainder of his life, it's necessary to decide whether to take that or not. And as you heard me say, I just had a discussion earlier in the presentation about age 78 being that crossover. And if you can afford to take it, that's the best guaranteed return out there, receiving that 8% delayed retirement credit from your full retirement age to age 70. Spousal benefits for non-US spouses. So I am whetting your appetites for the next presentation here, because we're not going to get into this in a whole lot of detail, because there's a lot we need to first understand about Social Security before we begin talking about spousal benefits for non-US spouses. But here's the remarkable thing about the Social Security program is that Americans, by virtue of the citizenship-based taxation system, and maybe this is possibly the only benefit to this structure. If you're married to someone who has perhaps worked in, lived in, or not even lived in, or even visited the US, then that spouse may be entitled to receive that Social Security benefit. It's important to say also that the spouse would be entitled to the survivor benefit, which is the worker benefit of the deceased spouse once they pass away. So once we have a widow or widower situation, they no longer receive the spousal benefit, the 50% reduced benefit. They receive the full worker benefit. Rules pertaining to it are highly specific, and we'll talk about the situation as for Australia next time, because that's very, very complicated. Okay, next month's webinar, here's what we're going to look at. So how you actually apply to take your Social Security benefit, what is the totalization agreement, and how does it affect you? Earning your US Social Security benefits for those who work outside of the US, that's kind of a follow-on from the totalization agreement. What is the WEP and how does it work? What is the GPO and what does that do to your benefits? And nothing good in either of those situations. But for that to be the case, it means you're getting more money from a pension. So it's the result of a good thing. When is the right time to claim? Well, the answer to that is it depends, like any good lawyer would say. Limitations on paying to foreign bank accounts. Don't forget to set up your US bank account before you leave, in other words. And which country has taxing rights on Social Security. Oh, and my favorite, no presentation like this ever goes without someone asking that last question, which I've already addressed. Can you get both? Yes, in theory, but that's an edge case. It's an edge case. You'll find some white papers at arete-wa.com. If you'd like to contact us to book an appointment to see if we might be able to consider working together on a private client basis, come here, click on Get Started. And otherwise, that's it. I am going to take a moment now and have a look at some of these questions and see if I can do my best to answer them. Okay, just maximizing that so I can read them. Starting with Debbie. Thank you, Debbie. In terms of qualifying, if you don't have 40 credits, can your time working in Australia count? Yes, is the short answer. Australia has a totalization agreement. Stay tuned for next month. And you can qualify, receive a partial benefit with as few as 6 quarters, so 18 months of a Social Security record. Corey, hi Corey. Is it possible that politics could change the 10-year vesting provision for an Aussie that has moved home or anywhere else in the world? Anything is possible. I haven't heard that one come up. You know, a lot of people that worry about the status of the Social Security Trust Fund, they say, oh, it's not going to pay anything. No, that's not true. I mean, it's still collecting this tax. And as we saw earlier, the Social Security Trust Fund expects they're going to pay out 79%. What are some of the other things that could happen? Well, they could change the amount of the tax. They could make a higher vesting period. There's any number of things that could happen. So I haven't heard that particular one, but that could certainly be a possibility. Carolyn, welcome. What if you take it at age 62 and invest the money instead of spending it? Wouldn't the return be higher, assuming you would make more than 8% on it? No, because, well, I shouldn't say no. I mean, it always depends, right? Like what's the investment? You know, had you done it throughout the course of 2010 to now, excluding the correction for that occurred in the first quarter of last year, would you have outperformed it? Maybe, but don't forget you have taxes to pay on both sides, whereas that benefit is accumulating tax-free. It's courtesy of the government. So I wouldn't say that, and I would never recommend that. It's a bird in the hand is worth two in the bush kind of situation. Andrew, hi Andrew. Some familiar names amongst these questions here. So Andrew, I am fully vested in Social Security and elect to live off my 401k assets from age 67 to 70. A man after my own heart. That's what I would suggest doing too. Does my 401k income count towards earnings for Social Security in terms of the highest income earning years? No, it does not. It's earned income. So no is the short answer. No, full stop. No need to go any further with that question. It's earned income. You need only go back to the slide that I had posted earlier about what is earned income, and Social Security is not earned income. However, as we'll talk about next time, Social Security is taxed by the US. As we know, it's taxable income, and also 401k is taxed. What the government giveth, the government taketh away with the other hand. So unlike superannuation, although while being a very good program, it does have its own fair share of issues too. With 401ks, you get the tax deduction on the way in, tax-free growth, but it's all ordinary income on the way out, unless you pull some some Houdini tricks that non-Americans are able to do in repatriating back to Australia. But that is the subject of a different webinar that I gave that you can find on my YouTube channel. Does your Rosalind, does your Social Security go up if you continue working after age 70? No, it doesn't. It caps out at 70. There's that 8% benefit increase from your full retirement age to age 70. And then at age 70, it would be in no way to your benefit to continue delaying beyond that time. There's zero situations that I can imagine where it would be advantageous. Even if you were making $1 million a year, it still doesn't matter. The tax rates aren't yet 100%. So even if you were making that in a 50% marginal bracket, you'd still rather 50% of your benefit than nothing at all. Carolyn, if now residing in Australia after 30 years, meaning I'm going to presume, Carolyn, you mean if you've been living in Australia for 30 years or you have returned to Australia after living away for 30 years. If now residing in Australia after 30 years, I think you mean the latter there. So you've been away for 30 years. Will I pay tax on Social Security in the US and Australia? The answer, stay tuned to next month's presentation where we'll go into that in a lot more detail. Anonymous, can you receive Social Security if you've only worked for 8 years? Depends where you're living. I don't know anything about you or your situation, so I'm not even, and you're anonymous, so I'm not even going to go any further with that one. David, hi David. If I stop working early, would full Social Security benefit amount change much versus continuing to work and accruing for the earnings? Hold on, if I stop working early, it's hard. 23 years working, which 13 years Social Security earnings maxed. So if I stop working early, would Social Security benefit amount to change much versus continuing to work? Not really. And you can model it out with, I don't think so. The way that the bend points are designed in the system, Social Security is intended to help lower income earners more. So in other words, let's say a $20,000 annual income increase that brings you, let's say, from 120 to 140, so right at the top of the Social Security income scale, versus earning a $20,000 increase from making $20,000 a year to $40,000 a year. Excuse me. So I'm trying to make a comparison of $20,000 at either end of the Social Security income scale is going to give you more benefit at that lower level. So a lower benefit, a higher level. Would be the answer there. But I would encourage you to look at those Social Security calculators and figure that out. Hi, David. What if you are retired and have only passive income? Does this affect your payout? No, it doesn't. Not one bit. You're in the clear. Jane, hi, Jane. Is it possible to retire early, not work, and then claim Social Security age 62? Assuming you completed, yes, it is. If you've got the assets to do that, my word, it is possible. And that I do see that situation all the time. If you've got the resources to get by until age 70 and you feel your health and life expectancy will take you beyond age 78, then why not do that and get that kicker that we saw earlier. Hi, Lena. Lena, roughly how much difference to pay out does working 10 years to qualify versus 30 years? $0. The only way to answer that, Lena, would be because the earnings record is going to be what would determine that. Typically, people make more money in inflation-adjusted terms throughout the course of their career. So it would typically increase, but in a hypothetical example, let's say you made exactly $50,000 in 1990 dollar equivalent, which would probably be more like $25,000 in nominal dollars back in 1990, and you made the same amount inflation adjusted for 30 years. Would it make any difference? It would make no difference. You would earn the exact same benefit. But because you probably made more in inflation adjusted dollars over time, it would make a benefit. I will say, really, Social Security comes up most frequently for my clients when they're thinking about how long to stay in the US. And even then, life, there's more to life than just money, right? But if they're in a situation where they're thinking of moving back and they're 9 years into vesting, okay, they're going to get some benefit if they're going back to Australia by virtue of the totalization treaty. But if they can just hang around for another year, be fully vested, that's a benefit that's going to pay, for the rest of their lives once they hit that retirement age. Lena, again, roughly, okay, sorry, that's me just reading that again. Ian, hi Ian. Unfortunately, my wife passed away. I'm sorry to hear that. Age 57. She worked in the US and accrued substantial income. At what time could I start collecting surviving? Age 60 is the answer to that as a surviving spouse. However, I don't know where you are, and if you're in Australia, I don't know how that could affect it. That's a real edge case situation, but surviving spouses are able to collect from an earlier age. If you need to, of course, you've got to do that. Again, I would always encourage you to defer given the increase. Sorry, I referred to Australian passive income and only have passive income. Does this affect your pension? No, it doesn't. It doesn't affect your pension because it's not incomes tested. It's not means tested. Rosalind again. Hi, Rosalind. I mean, if you continue working after 70, does that income make your Social Security rise? No, it doesn't. Was living in the US OASDI for the last 30 years. So Carolyn, appreciate that. Let's go back. If now residing in Australia after living in the US for 30 years, will I pay tax on Social Security in the US and Australia? Yep, we'll address that next month. Amanda, hi Amanda. If I turn 70 in 2035 when the trust fund depletes, should I start taking my Social Security at age 67 and get the max? The thing is, there's just no telling. I think keep your ear to the ground, see how the status of the fund goes. I think that we're going to see major changes. Of course, this is a politically, it's what they call a lightning rod. No one wants to touch it because there are so many millions of retirees utterly dependent upon it. You may recall back in the early 2000s, George W. Bush had made overtures about privatizing Social Security, and that was just something that wasn't going to go anywhere. So I think it's so politically important. There's going to be some changes to it, and as it is, if that's your only source of income, which unfortunately it is for many tens of millions of Americans in retirement, it is a pretty tough budget to make work. So I think keep your ear to the ground. Let's stay in contact and see where that goes. Rosalind, what is the best way to claim Social Security in Australia? Is it best to keep it in the bank here and transfer it every 6? What a fantastic question, Rosalind. And I love that sort of question. And that comes back to, I'd refer you to my foreign exchange webinar on YouTube. Go to my YouTube channel. We talk about foreign exchange. And Jan, it's so funny that you happen to be next in line here, given that we're talking about this very topic. So does it make sense? Well, it kind of depends on where you see the exchange rate going. Well, all I can say is the long-term average of the exchange rate since floating in 1981 has been 72 cents. Thus, it would appear the Aussie dollar is slightly stronger than average. I'm not going to use the words to say overvalued, because that would imply there's some fair value to it, and there simply isn't. It's the difference in the demand for these two currencies. But that is a nice plug. I try not to make these webinars too commercial, but my clients get the best exchange rate that's out there. We've negotiated 0.1% spread with a company called AFEX. So talk to AFEX and David Gunkel. We did a webinar, as you heard me say a minute ago, and you could probably get a very competitive rate. Not as good as what we've got, but probably a very good rate. Jan, if we do a 5-year working stint in the US, come back to Australia and then go back to the US, would that be treated as if we worked? Yes, it would. It doesn't matter. It doesn't need to be continuous. You would vest in, yeah, yep. Good to see you, Jan. Hope you're well. Anonymous attendee, again, if my wife is Australian, I'm American, and the one with benefits available in 10 years, okay, and I want her to have the right documents and instructions on how to get my Social Security after my death, what should I give her? Is there a document that explains what she needs to do after I die? Wow, well, that is an interesting one. Gosh, I would say it's not that complicated. It's more a case of simply go to mysocialsecurity.gov, create that record, print that out, and then get a hold of the representative. There's a Social Security overseas office in the Philippines, and they would be able to point your wife in the right direction. You can model the amount that you expect there to be, and hopefully she doesn't forget about that. Other questions that have appeared on the chat window. Hi, Sue. If we are approaching retirement, both age 62, is it worth moving our 403B into, hold on, triple tax-free state bonds? We live in New York State. We are both 62 years old. You know, this reminds me, I was out at dinner the other week with my, I guess you could call her my mother, stepmother. I don't know exactly what, my father's life partner, how about that, who happens to have spent a career working in the US. She's moved back, and I was asked about my opinion as to her retirement income plan. It's very difficult. It's very difficult. I think the very first thing you need to do is to decide on what is your retirement income plan, of which there are 4. It sounds like you're thinking of the first approach, and that is the income and dividend approach, where you simply live on the income and dividend of your portfolio. One way to do it in terms of survival, like probability of success in retirement, that has the lowest probability of success. The other alternative, the one I tend to like the most, it's not always the best, but a very simple one is retirement income guardrails. Depending on the feedback from today's presentation, I may do a webinar on that. What's the retirement income guardrails approach, and how does that work? That's looking at your portfolio overall. So we're not just trying to live on the dividends and interest of your portfolio. We're looking at the growth too, because if you look at the US economy right now, we've got the highest valuation numbers since, well, the second highest of all time after the late 1990s, and we've actually surpassed 1929 right now. So the interest rates are 0. So I really think it's going to be difficult to earn an income of any kind of bond in today's environment. That being said, we've had a tremendous run up these past 11 years. We've had phenomenal growth, absolutely phenomenal growth. Everyone likes to talk about real estate and what real estate's done, but it pales in comparison to had you simply been invested in the S&P 500, which would be double what housing has done in Australia. That's a comment for another time. So going back to retirement income guardrails, what if you invested your entire portfolio and instead harvested the amount that you need on a quarterly basis, but invested it on a total return basis? So you would have less that would be subject to ordinary income tax, which wouldn't be a risk with your bond approach there, but it would be more efficient than a corporate bond approach. And typically it's shown to have much better success rates than the dividend and interest approach that you're inferring. Is there someone for whom that might make sense or be optimal? Probably not, probably no one. The only time I get excited about muni bonds is when someone is in that highest marginal tax rate, which currently is about $600,000. So if you're making that kind of money, then absolutely go for it, but that's not everyone's situation. Is superannuation income then, Ariel writes? To the US, it could be. So it depends on your immigration, your legal status of the US. Nigel Scott, can you receive Social Security disability benefits after moving back to Australia? Wow, I have never been asked that question, and I don't know the answer to that one. I don't know, I'm afraid, Nigel, but that would be a phone call to again, to the Social Security office in the Philippines to ask them about that. Last couple questions before we round things out here at 1/2 the hour. Where are we? David, how do you calculate your spousal benefit? Please assume they are a US citizen but wouldn't qualify for their own Social Security. Easy. Take your worker benefit, multiply by 0.5 or halve it. That's what your spouse would get. That's the spousal benefit. It's half of the worker benefit. Ian, a follow-up question. If I started collecting surviving spouse benefits and later started collecting my own Social Security benefit, would I get paid both benefit payments, or does activating my... I think you get both. Ian, this is, I hate to not have an answer, as I didn't have one a moment ago with Nigel. And I'm sorry about that. This is a tough one, or I think the law changed on that in 2016, but I'm not sure. I'm really not sure. It's either still possible to do that, or they closed that particular loophole. Feel free to send me an email and I'll look into that, because I really want to know that answer, because that really could be of substantial value to a lot of people knowing that. David, potential future topic, healthcare and health insurance in the US versus Australia before reaching US Medicare age. You have to clarify that a little further, David. Healthcare, costs 2 or 3 times the same, the price in the US for the same thing. Medicare versus the system in Australia. What I will say, the thing that comes to mind when I read that is what you don't want to do, or what you want to be mindful of, is finding love later in life, moving to the US in your 60s without having at least 5 years of that Medicare tax history and not qualifying for Medicare at all. That is a very unpleasant place to find yourself, because if you're in the US above Medicare age, it's pretty nasty in terms of what health insurance costs. Jennifer, hi Jennifer. I am single with no plans to leave a big inheritance, which means my 401k and Social Security available for income. Which of the 4 should I be looking at? Okay. Should you be looking at? Well, my answer is look at all of them, of course. And no plans to leave a big inheritance, which means they're available for income. This is interesting, and that's kind of what, and I don't mean this as a plug, but that's kind of where typical retail, consumer-facing tools tend to fall short. What you're talking about is income sequencing, and that is, which account should you pull from to get the lowest tax impact, have the lowest tax effect? And that's something I go through with clients, of course, but the answer to that would be, you need to look at, first of all, how much do you need to live on? And there's 3 scenarios I'd invite you to look at. Basic, comfortable, and dream retirement scenarios. Look at all 3. How much does it cost on a monthly basis? Don't forget to factor in non-monthly expenses as well, like home maintenance, dental, apparently, and unexpected health expenses in retirement. Factor in some of those things. Also an emergency fund. Figure that out, and then say, okay, I now know that I need $5,000 a month. Okay, $60,000. Where does that put me on the income scale in the US versus Australia? Then you would figure out, okay, I want to keep as much of my income as possible in the 12% bracket. How do I do that? Well, remember, 401k is going to be taxed as ordinary income, so it's not coming from there. We talk about, I have a retirement philosophy called ORIP, optimal retirement income planning. We had to put that O in front because RIP, when talking about retirement income planning, gave the wrong impression to people. There's a joke there. So optimal retirement income planning is, you want to fund your different tax buckets going into retirement. You want to have your tax deferred, that's your 401k. You want to have your capital gains bucket, there's your after-tax brokerage account, and you want to have your tax advantage bucket, that's your Roth account. Because having all 3 enables you to pick and choose where you're taking your money from in order to get the best tax impact. So that seems to be the last question. Thank you everyone for attending today. This has been a phenomenal turnout, and really, really fantastic amount of engagement here. So please do let your American friends know. Thank you, Nigel. Please do let folks know, and feel free to subscribe to my YouTube channel. The recording of this will be made available in the next 24 hours. and we will notify you. And thank you, Andrew. Good to see you too, as always. Yes. All right.